Consumer prices accelerated 8.3% year over year in April, slightly more than the street was looking for and near the highest level in more than 40 years. The core CPI was also higher than expected. Our chief equity strategist and economist John Blank is here now to help us make sense of this economy. Month-over-month gains, John, also higher than expected. Was there any good news in that data?
Yeah, Terry, the gas prices seem to have topped out a bit. We also saw some early signs that the used car prices have topped out a bit. And to no surprise, there was a subtle hit on a cut in apparel prices, and that was reflected later on after the CPI data in the week earnings reports from some of the retailers. So clearly, also there's been some discounting and some slowdown in clothes purchasing at the major retailers, and that does subtly indicate across the board that there's at least some topping process in narrow sectors of the economy, not broad ones. And I would add, since then, we've also gotten pending home sales and existing home sales down. Not down as far as people are talking about, because they're in year-on-year terms from the pandemic levels, and they're getting overstated that way. But they're getting back down to normal, over the last 3 or 4 year levels, and that is also going to help reduce the pressure on prices.
Over the past year, John, real earnings have dropped, but average hourly earnings have risen. And April retail sales were up as well. So some mixed news there, but as inflation continues to rise, how long do you think it might take for consumers to cut back on spending?
Harry, I'm not actually bearish on consumers. I think, the long COVID pandemic really built up a lot of demand for consuming. And I think, in addition, there was a lot of savings that were created during the pandemic that are at historic highs. And you have to, understand that the repair to the personal balance sheets has been exceptional, and the savings rates are exceptional. And also, you've got a consumer that's pent up. So I don't really think 200 basis points in the Fed funds rate is outside of the housing market is going to have a bit of an impact on most consumers, and unless they're, people who are very rate sensitive, and that's only going to be the early home buyers.
All right, what about this? As we hear now about the possibility of gas rationing, rising housing costs, and the jobs workers gap. Key question, one that a lot of people are asking, is can the Fed slow the U.S. economy enough to bring down inflation without causing a recession? What do you think?
Well, here's the thing I think about. I mean, I take it in the housing context. I did a thing on Bull Bear for housing, which you can find on Zach's Professional Services on YouTube. And what I found out, Terry, I wasn't trying to find this out. I didn't have this confirmation bias. But when you look into the ratcheting up of the 30-year fixed rate, and you say, yeah, of course that's in the news. Yeah, of course that's slowing housing down. But then I looked at my other 10 points, and 7 or 8 of them were bullish. And this is what I will remind people of. The Fed has a cushion in place from COVID that may allow a soft landing to come about in a way that hasn't been in the historic data, because there was never such a cushion in place. So I would caution people on relying on 60 years of historic data when, in fact, you have a 100-year event that has to be factored into that story.
All right, let's take a little broader view here. Has the world economy seen peak consumer price inflation yet?
Woo! That's a tough one. Terry, I don't think so, because I think we've got to get to the fall, and I think there will be an apex moment for the Ukrainian conflict. And until that happens, it's very difficult to see the supply shortages for Europe start to unwind. And, as long as we get a climax moment in Ukraine, there's going to be problems in Europe, particularly in gas and oil. And then you've got the Chinese story. And, there I have a little more grounds for optimism, because I do think they will get their COVID shutdowns out of the way and reopen. But that isn't good news for inflation in China, by the way.
With some disappointing results from bellwether retailers that have been reported, do you see a wall of worry going on in that group?
No, I see, individual stories that have some resonance. But, they've been dealing with port shutdowns and supply shortages for so long. A lot of the skewing of the data, particularly like building of inventories, a lot of people pointing at it as a bearish point of view. I will tell you, if you have huge shutdowns of ports and big backlogs of ships, any smart purchasing manager will build inventory and just avoid the problem. So I think, we are going to see some unwinding of these exceptional circumstances in the retailers, particularly the mass merchant ones. But I think the balance sheet story for personal balance sheets is going to be very, very robust for the Macy's, the Nordstroms, and the Williams-Sonomas.
So then, basically, is that what the retail earnings have told you about the consumer in general, or is that base weakening?
No, I think it's telling us that, there's caution on the outlook for the retailers, but that's just going to improve their ability to beat later in terms of earnings. And actually, I think the bottom really is in the retail story.
Let's take a hypothetical here. Should U.S. consumption turn down in the face of high final point of sale prices seen at the major retailers, is that going to be a signal that the Fed is not going to be able to tame inflation?
No, it's going to help tame inflation. I mean, one of the other interesting things here is you get high prices and they self-correct, demand. So even in advance of the Fed fund rate hikes, which, by the way, usually tackle investment, business and residential fixed investment, the consumer slowdown will come through the high prices. And that's something, and again, that's Fed's trying to tackle, but in advance of their ability to tackle it, it will slow down consumer spending.
So what will the 10-year U.S. Treasury rate tell us about the economy going forward?
Well, the 10-year U.S. Treasury rate, Terry, needs to be understood as the, quote, neutral rate, which is where the Fed will stop raising rates on the short end when it begins to, the long end reflects all the short ends that are in view for 10 years or 5 years. So right now, if it's at 2.75, that tells you that's the neutral rate for the Fed at this point in time, at least what the bond market's telling you.
And if our listeners are looking for stocks to consider now, you say they may want to look at Analog Devices, Nutrien, and Nucor.
Yeah, Analog Devices, ADI, great chip stock. It's very defensive, very good stock to look into it, a defensive market, chip supply shortage. Nutrien, unbelievable opportunity in fertilizer because of the crop shortage of the Ukraine story. And then Nucor is the steel play. And here you've got a subtle defense armament play, and you've got a transportation play, and you've got a commodity price play. So these are, again, three names that I like because they really do reflect what's going on at this stage of the cycle.
Our chief equity strategist and economist, John Blank, on the economy, both domestic and global. With John, I'm Terry Ruffalo. And you can check out a new Zacks special report, Cashing In on the Metaverse, the next internet boom, which features 5 stocks poised to soar as they power this radical new technology. For more details, go to Zacks.com/promo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.